clear line. Your profession is one thing, your business is another. Your job might be, I don't know, being a chef or an engineer.
Right. That's your profession, how you earn active income, perhaps.
But your business, he says, should be focused purely on building that asset column.
Minding your own business, as he puts it. Your business is your asset column.
And doing that effectively requires what he calls financial intelligence or financial IQ. He breaks that down into 4 parts.
Yes, 4 key pillars. The first is accounting. Financial literacy. Basically, can you read the numbers? Can you understand a financial statement?
Knowing where the money is actually going, the details.
Exactly. Left brain stuff. Knowing income, expenses, assets, liabilities.
Okay, pillar 1, accounting. What's number 2?
Number 2 is investing. He calls this the science of making money. This is more creative, more right brain. It's about strategies, seeing opportunities, putting capital to work effectively.
So strategy and execution. Got it. Pillar 3.
Pillar 3 is understanding markets. This is the science of supply and demand. It involves understanding both the technical side, market sentiment, psychology, often driven by fear and greed.
The emotional waves.
Right. And the fundamental side, the actual economic sense of an investment. Is it overpriced, undervalued? What are the real drivers?
Okay, accounting, investing, markets. And the 4th pillar is the law. That sounds important.
Crucial, especially as you build more wealth. This involves understanding things like corporate structures, regulations, and especially tax advantages and legal protections.
Taxes again. It seems the wealthy play by different rules, or at least use the rules differently.
That's a big part of his argument. The financially intelligent understand how tax laws work and use them strategically.
Which brings us neatly to the power of corporations. He talks about a corporation not as a big building, but just as a legal structure.
Yeah, he literally says it can be just a file folder with legal documents. But that legal structure offers massive advantages.
Like what are the big ones?
Well, the huge one is tax advantages.
Yeah.
This is where that before tax dollars idea comes back. A corporation can often pay for certain expenses before taxes are calculated.
So things that an employee would pay for with after-tax money.
Exactly.
Yeah.
Things like potentially car payments, health insurance, even travel if it's framed as a board meeting or business research. The corporation spends the money first, then pays tax on the profit that's left. Employees earn, get taxed, then spend what's left. It's a different sequence.
That's a fundamental difference in cash flow right there. And he mentioned legal protection, too.
Yes, that's the other big piece. Corporations and certain trusts can create a shield between your personal assets and business liabilities or lawsuits. In our quite litigious society, this allows the wealthy to effectively control assets without legally owning them directly in their name.
Control everything, own nothing.
That's the concept. It helps manage risk and protect wealth from creditors or legal challenges.
Okay, so understanding assets, building financial IQ, using structures like corporations, that seems like the blueprint, but knowing isn't doing. What holds people back? Kiyosaki points to 5 main roadblocks.
He does. Even if people grasp the concepts, he says these 5 things often stop them. Fear, cynicism, laziness, bad habits, and arrogance.
Let's tackle fear first. That seems like a big one with money.
Huge. He has this great line, people are so afraid of losing that they lose. Meaning, the fear of losing money in investments stops them from ever investing, so they lose out on potential gains.
The fear itself causes the loss of opportunity.
Exactly. He points out that most rich people have lost money at some point as part of the learning process. But many people who struggle financially haven't lost money investing because they never took the risk.
He sees losing differently then.
Completely. He says, for winners, losing inspires them. For losers, losing defeats them. He even uses the Alamo story, how a major defeat became a rallying cry, remember the Alamo, turning failure into motivation.
That's a powerful reframe. Okay, what about cynicism? The Chicken Little effect, he calls it.
Yeah, the Chicken Littles are always shouting, the sky is falling. They criticize and complain, but they don't analyze. This constant negativity, this doubt, it blinds people to opportunities.
Especially when things look bad.
Especially then. Often, the worst of times financially are actually the best times to buy assets cheaply if you're analyzing instead of panicking. Cynicism just keeps you on the sidelines.
He also mentions the I don't wants under cynicism.
Right, like someone saying, I don't want to invest in real estate because I don't want to fix toilets. That single objection closes them off to a potentially powerful investment vehicle.
And Rich Dad's solution.
Simple. Find someone who does want to fix toilets. Hire a property manager. Don't let a solvable problem kill the opportunity. Focus on the goal. not the minor obstacle.
Okay, fear and cynicism are external looking, maybe, but then he talks about laziness and bad habits looking inward.
Yeah, this is about personal discipline. He controversially suggests that often people who say they're too busy are actually using busyness as an excuse to avoid tackling hard financial questions or making changes.
A form of laziness, he implies.
A form of mental laziness, perhaps. He contrasts the statement, "I can't afford it," which shuts down thinking, with the question, "How can I afford it?"
Turning it into a problem to be solved.
Exactly. It forces your brain to look for solutions, for creative ways to achieve something, rather than just giving up.
That's a subtle but powerful shift. And a key habit he pushes, which sounds really hard, is pay yourself first.
Yeah, borrowing from George Classon's The Richest Man in Babylon, Kiyosaki means literally putting money into your asset column before you pay your bills, even taxes or creditors.
Wow. Okay, how does that even work? Doesn't that create huge pressure?
That's the point. He argues that pressure is good. It forces you to become smarter, more creative, more active in finding other ways to generate income to cover those bills. It makes building assets non-negotiable.
It forces financial ingenuity out of necessity. Okay, that's intense. The last obstacle, arrogance.
Arrogance, he says, is often just ignorance wearing a mask. People who are arrogant about money often stop learning. They think they know it all.
So they close themselves off to new ideas.
Exactly. A truly intelligent person, financially or otherwise, is humble enough to know they don't know everything. They welcome new perspectives, they learn from experts, even if they disagree initially. Rich Dad's line was, "What I don't know loses me money."
So stay curious, stay humble. Okay, we've covered the philosophy, the hurdles. What about practical steps? How do we actually start awakening our financial genius?
He offers a list of 10 steps, but a few really stand out. One is to invest in your education, continuously. Your mind is your single greatest asset.
So reading books like his, going to seminars, listening to audio.
All of it. And being willing to maybe unlearn some old ideas. He talks about listening to an audio clip repeatedly just to grasp a different perspective. It takes real effort.
And related to that, being careful about who you learn from.
Absolutely. Choose your influences wisely. Don't take financial advice from people who are struggling or constantly fearful, the chicken littles. Learn to do your own analysis. Trust your own judgment more.
Makes sense. And he also talks about mastering formulas.
Yes, master a formula, then learn a new one. The key is the speed at which you learn. Financial markets change. Opportunities shift. You need to be adaptable. And part of that is being proactive, like his advice to make lots of offers in real estate.
Even if you don't expect them all to be accepted.
Especially then. Make offers with escape clauses, so you're not locked in if things aren't right. But don't wait for the absolute perfect deal that might never come. Action creates opportunity.
And his point about shopping for bargains is quite telling.
Isn't it? People love a sale on everyday items they stock up. But when the stock market or housing market crashes when assets go on sale, most people run away scared.
Instead of seeing it as a buying opportunity.
Exactly. Kiyosaki stresses that profits are often made when you buy low, not just when you sell high. He used this himself, right, in that Phoenix example.
Yeah, tell us about that again. How did he create money there?
The market was depressed, lots of foreclosures. He found a house for, say, $20,000 that was worth $75,000. He put down a small amount borrowed from a friend, maybe $2,000. Then instead of fixing it up, he immediately advertised it as for sale by owner, no money down. Someone eager to buy but without cash jumps at it. They agree on the $75,000 price. Kiyosaki gets them financed, pays off his $2,000 loan, plus maybe closing costs, and the buyer gives him a promissory note for the difference, say $40,000 or more, secured by the property.
So he created an asset, that note receivable generating income with very little of his own money in just a few hours.
That's inventing money through financial intelligence, using the system. It wasn't about working harder. It was about seeing the opportunity and structuring the deal.
He also scaled up using a specific tax strategy, starting small.
Yes, the gingerbread house story. Started with a small house, maybe $5,000 down, generating just a little cash flow each month. Then, as it appreciated, he used a 1031 tax-deferred exchange.
How does that work, simply?
Basically, it lets you sell an investment property and roll the profits into buying another, similar investment property without immediately paying capital gains tax on the profit. It allows your money to keep growing tax-deferred.
So he could trade up to bigger properties.
Exactly. He rolled the equity from the small house into a slightly larger one, then into a multi-unit building, eventually acquiring a 30-unit apartment complex. Each step built on the last, using leverage,